welcome to the ATAA Sydney chapter meeting for the 21st of March, and a very warm welcome to each and every one of you. Thank you very much for attending. Our disclaimer really is important to state that this is purely for education purposes only. We're not giving any advice, whether financial product advice or otherwise, and if you hear anything that you believe would assist you with your trading, please do not do any trading without getting prior financial advice. So this is our agenda. It's a very full agenda tonight, and we're very pleased to have Richard Brennan of ATS Trading Solutions here, and he'll speak for the first half of approximately 1 hour, and then we'll have a break for 5 minutes, and then Richard's going to get into the interesting, equally interesting practical side of it, and his topic is mimicking the techniques of the classic trend followers. So, but we will have a 5-minute break just in between those two halves. I'd like to introduce you now to Richard. Richard is a science enthusiast with a long-standing track record in the financial services industry, both as a trader, risk manager and fund compliance professional. Given his leanings towards the quantifiable and verifiable, Richard is a strong advocate for systematic and diversified trading styles that avoid the need for discretionary decision-making. Richard is a content producer on his site, the ATS site, and is also principally involved in the program analytics and portfolio compilation of the ATS activities. So I know we've got a lot of people on this call very interested in this topic, and what I'll do now is I'll transfer the screen to Richard. I have to select his name and share the screen with him.
Thanks, Daryl. I think I've got it now. I'll just set this up on the right screen. Now, hopefully you can see the presentation there, Daryl.
Perfect. Can I just say one thing before you started? I apologise for this, Richard. For people who may not be used to this site, if you want to bring your cursor up where you see the two windows, in other words, you've got the list of attendees and then Richard's presentation. If you bring that window up, and then what you can also do is increase the resolution. So mine says 71%, so you can increase that so that you can see more of Richard's screen. If you could mute yourselves and not be on the web cam, that would be great. Thank you, Richard, once again, and it's now over to you.
Well, thank you very much, Daryl, and thanks for the opportunity of speaking to the Sydney chapter. As you're probably aware, I'm a Brisbane member up here, with the Brisbane chapter up here, but it's great to get around. And look, tonight I thought I'd be doing a presentation on what we refer to as classic trend followers. But look, before we start, I'll just get into the obligatory disclaimer. I'll just put it up on the screen for a while, just for a couple of minutes while we catch our breath. And I believe this presentation is being recorded, so anyone who wants to look at this in fine detail, please do with the recorded presentation. But it's a typical disclaimer. So rather than reading it all out, I think I'll now slip through into the presentation. So in talking about classic trend following, what we are referring to are what we call diversified systematic trend followers. And it's a systematic approach to trading the markets and targeting directional outliers. Outliers are also called anomalies, which you might find in liquid market data, and they're very large-scale directional anomalies in the market data, which most traders who trade mean reversion or trade pattern recognition, they tend to avoid these anomalies. They treat them as anomalies, and they often exclude them from their statistical analysis because they regard them as infrequent, unpredictable directional anomalies. But they're the actual features of the market that we are targeting with this approach called classic trend following. So as you can probably be aware, we therefore have a very counterintuitive approach to trading the markets, which is different to what many people do when they trade the markets looking at a predictable pattern or a predictable oscillation. These things are unpredictable in nature, but they're significant directional events which really have the ability to be a game changer in your career path. Some of these anomalies over the last 30 years we've seen, such as silver, gold, a lot of the commodity trades. They're so large that simply catching one of these single anomalies is enough to set you up for a long period of time and recover a lot of the possible losses incurred in trying to target these particular features in the market data. This particular approach of trend following has been made popular by what we refer to as commodity trading advisors. You might have heard of them. They're called CTAs in the USA. And they were particularly popular in the 1980s in their trading of futures commodities markets. But subsequent to the 1980s, they have expanded across every liquid asset market class. And some of the names you might have heard of who practice this technique are the likes of Richard Donkin, who developed the Donkian breakout indicator. Richard Donkin was a famous trend follower back in the 40s. Ed Sakota, who we've probably heard of. The turtle traders, such as Richard Dennis and Bill Eckhart, who set up the turtle traders, and some of the traders themselves, such as Jerry Parker, they practice this classic trend following approach. Tom Basso, who I believe you've had or you're having at your conference. David Harding of Winton Capital, and Marty Bergen of Dunn Capital. Some of these funds you might have heard of. They're not really well known, to be honest with you. They tend to be shrouded by other big names, but they certainly have a demonstrable track record over 30, 40 years. Now in 2012, I've been trading these markets since about the mid-1980s. And it was in 2012 I decided to change my tack and basically attempt to follow in the footsteps or stand on the shoulders of these professional fund managers with a very long-term track record. So I firstly needed to identify who these trend following funds were, and so in doing so I noticed that their performance track record stood up very well against some of the best in the world. And it made me particularly interested because I noted that we didn't just have a handful of trend followers or classic trend, very robust and strong performers over a very long-term track record, but we had such a large number of them that you soon realize that it's the technique itself which is very robust, and you don't necessarily need the skills such as the skills of the Medallion Fund and Renaissance Technologies, such as Jim Simon's fund or the fund, the quant funds of 2 Sigma. You don't need these sort of skill sets to trade this way. You don't need a quantitative research arm behind you to trade this way. You just need a rules-based process and a disciplined mentality to follow those rules at all costs. So looking at identifying these particular forms of hedge funds called classic trend followers, there's about 59 of them that are trading currently today that have at least a 15-year unbroken track record. The way I've identified them is I use Nielsen Hedge Fund Database. They capture the performance returns of the professional fund managers of hedge funds, and they've got about 4,000 programs in that database. And then we apply particular criteria to then isolate out those that we regard as classic trend followers. So they need to be geographically diversified across a broad array of asset classes such as commodities, forex, equities, metals, hard and soft commodities, bonds, fixed income. They need to be fully systematic in nature. Now, we'll get into why they need to be systematic. It's not because we've elected to not be discretionary. It's just that this method demands a systematic approach, and I'll show you why. These funds, to get onto my sort of my list of funds to follow, they must possess at least a 15-year unbroken track record. That's my test for robustness. It's better than any of these alternative risk metrics you might have heard of, such as the Sharpe ratio or the MAR ratio or other different forms of risk metric, because the actual validated track record demonstrates how these fund managers have been able to stand up to an array of different market regimes over a very long period of time. So it requires a particular form of expertise to be able to possess an edge over such a very long period of time that they demand a bit of attention. So I identify those fund managers that are regarded as classic trend followers and have at least a 15-year track record. And of course, they must adopt trend following as their dominant technique in their program, their dominant investment strategy. So of the 59 programs, you'll need your glasses here to see the 59 programs, but perhaps you can review this in the recording that's taken. But in this list of 59 programs, you'll notice that the assets under management, which is this column here, we're dealing with some very large funds, such as Fort, which runs a program, has around about 410 million assets under management. Some of them have 6 billion assets under management. Things such as ISAM, MAN AHL, you may have heard of. One such as Dunn Capital Management, we've already talked about. Chesapeake is a good friend of mine, Jerry Parker. He runs his fund in this selection. Eckhart Trading Capital is, of course, Bill Eckhart's fund. He set up the Turtle Trader experiment with Richard Dennis. So there's a number of names you might be familiar with in this list of 59, but importantly, all of these have got this unbroken 15-year track record. When you go back in time in this inception month, you see that some of them were around in 1984 to current day. They're all trading to current day, some of them as long as 1980s up to current day. I think there was even some around the 1970s that started off. We notice that their performance metrics are very similar, and that's because they adopt a similar style of trading, and you'll find that they are particularly uncorrelated to the S&P 500. So this is one of the advantages of this particular type of program when you're looking at developing a portfolio where you're looking at how to allocate some alternative investment programs into your portfolio that might have a large proportion of it invested in US equities, for instance. So the classic trend followers is an ideal program to possibly include it as an allocation into a wider portfolio that you might have heard of the 60-40 portfolio, which is typically invested 60% in US equities and 40% in US bonds. If you've got concerns about the performance of bonds in the future, you might consider replacing your 40% allocation in bonds to a 40% allocation in this style of fund, because they're particularly uncorrelated. And as we'll see in the performance track record over the last 3 or so years, where markets have become incredibly volatile, these funds do perform very well. There is this terminology applied to this style of fund, which talks about these funds offer crisis alpha. What this means is that during periods of high volatility, when equities are declining in value, these have shown, at least historically, that because of their uncorrelated nature, that can provide some sort of hedging degree of exposure to protect your downside exposure if you are significantly allocated towards equities. Look, I'm going to try and get through this formal presentation quicker so that we can get to the fun stuff at the end. So I'm just going to monitor my time here, and I'll try and push through this quite quickly. But so when we compare the performance of this style of classic trend following to other notable investment, we've all heard, of course, of Warren Buffett's program. I noticed that Berkshire Hathaway, a share in Berkshire Hathaway today is worth $500,000. That's quite a large amount to pay for a single share in Berkshire Hathaway. But this chart here shows yellow being the Berkshire Hathaway performance, and all of these other squiggles are the 10 different classic trend following funds who have had a very comparable performance to Berkshire Hathaway over the last 22 years. So quite clearly they can demonstrate that they have a very robust, strong performance track record, and there's a lot of them. This was just the top 10 that I selected here, but of that listing of 59, you'll find that most of them plot within Berkshire Hathaway's performance returns. What we'll notice also is that with Berkshire Hathaway's performance return, Warren Buffett, of course, is a value investor. This is it's a different form of trading philosophy to what I'm talking about tonight, which is classic trend following. But the similarities are that both are very counterintuitive forms of trading. So there is a sort of key ingredient here, which is a synergy between these two forms of strategy, value investing and trend following, in that they are counterintuitive in nature. In other words, they go against the trend of what the majority of market participants trade. They tend to trade in a counterintuitive way, and because of their counterintuitive posture, when they're right, there's a vast flow of funds from those who get it wrong towards them, but when they're wrong, there's a small flow away from them. So if you could imagine, if 95% of the market participants are trading a dominant style or a particular technique, if 5% of them are counterintuitively positioned to them, when you get an event which is against the 95% crowd in a zero-sum game, there's a massive flow of wealth towards the counterintuitive traders. That is where there is a bit of an edge created through these techniques that are counterintuitive in nature. What we do find when we compare the performance returns of these classic trend followers against Berkshire Hathaway over the last 22 years is that a lot of them exceed the performance returns in compound annual growth rate to Berkshire Hathaway. Berkshire Hathaway pulled in a 10.6% compound annual growth rate over this 22-year period. But we have a number of the classic trend followers with returns of around 13.5%, 12.6%, 13.3, 12.3%. This is the compound annual growth rate. So they certainly are in line with Berkshire Hathaway's performance. But we'll also notice that their drawdowns are lower than a Berkshire Hathaway's. Now, what this therefore does is it creates what we call an optimal risk-weighted return. In other words, they can produce strong compound annual growth rates with a lower drawdown, which means that if we decide to leverage our investments towards these funds, there's more than enough opportunity to apply a degree of leverage to investments in these style of funds to lift the returns further, but that also means there'll be a corresponding increase in the drawdown. However, because these offer a lower risk-weighted return to, say, Berkshire Hathaway, we use the MAR ratio, which is the compound annual growth rate divided by the maximum drawdown in percentage terms. That produces a ratio called the MAR ratio. That tells us their degree of risk weighting. And we see that nearly all of these classic trend followers have a higher MAR ratio than Berkshire Hathaway. There's only one here, which is super fund capital management, which is this blue squiggly line here. Super fund has a lower risk-weighted return, but all of the others have a higher risk-weighted return. But importantly, as I've said before, what matters really is not the risk metrics themselves, but the validated track record. And that's something I really take heed of. Who are the fund managers who have demonstrated with these validated, audited results, which are demanded because these are programs that are offered to the investment community, and the regulators insist that their records are audited. But also we've got to recognise that these returns are after the fees and expenses have been taken from these programs. So the typical fees and that are charged by these programs might be a 2% management fee based on assets under management and a 20% performance fee based on a high watermark level. And so these returns that are delivered are after those fees have been paid out. So we'd expect the gross returns higher than the compound annual growth rate listed here. Now, when we look at, when we compare, for instance, a buy and hold approach with the S&P 500, we're all familiar with the very strong performance returns of the S&P 500 since post-2008, post the GFC. So we're all familiar with the very strong growth in equities over this period of time. But we want to compare the performance of a buy and hold approach in the S&P 500 against an index of the top 10 trend following funds. So in this top chart here, I've got this index which comprises an equal allocation of 10 trend following funds against the S&P 500, which is this grey line here. We can see that the 10 trend following funds outperform the overall S&P 500 index. But also, if you closely look at the trajectories of these equity curves here, you'll notice that the equity curves of the trend following funds, whilst they are volatile, they've got lower drawdowns than what the S&P 500 has delivered over this period of time. So when we look at the S&P 500, we will see that there were two drawdowns here, these two peaks here, of plus 45%, almost 50%. Back in 2008 with the GFC, and back in the tech bust back in 2002. These were both drawdowns of the S&P 500 of around about 50%. But up here with the trend following index, we'll see that the maximum drawdown reach was around about 20% over the course of time. But you will notice that the drawdowns are fairly perpetual right throughout the time series. This is because a trend follower almost perpetually exists in drawdown, and I'll explain why a bit later, versus the S&P 500, where there are certain periods of time where it's continuing to rise and we're never getting drawdowns. However, during these significant equity crisis periods, we get these massive drawdowns occurring. Now, this feature of trend following funds being always in drawdown is because we are targeting these outliers. These outliers are these unpredictable. If you could imagine, if we elect to start trading a trend following approach, we never know when those outliers are going to arrive. And so initially we might be trading for 6, 7, 8 months, getting small losses along the way, patiently waiting until these markets display these massive directional moves, and then we jump on board these anomalies. So it's different to a trading technique that is trying to extract an edge from a repeating pattern or an oscillation in the market, because those techniques are relying on that pattern existing, and therefore when they apply these trading strategies to attack that pattern, you want to see that that performance immediately continues into the future. So you want to ensure that that edge that is present from that current pattern that you're trying to trade continues on. Now, this is different to a trend following approach, which is a patient approach of sitting waiting until these outlier events emerge. And therefore, that waiting time means that you're inevitably always in drawdown. But because of the risk mitigation methods that we embed within our trend following systems, those drawdowns never get out of hand. Over here, when we look at the monthly returns, we'll notice something quite curious between the S&P 500 monthly returns and the trend following index monthly returns. Now, what I've done is I've color-coded these, highlighted them, to show dark red months are months of greater than 8% adverse monthly returns for a trader. You'll notice in the S&P 500 we've got a large number of dark reds in the monthly returns. You'll also notice there's quite a few dark blues. Dark blues are very positive, plus 8% returns for a month. Now, when we come up to the trend following monthly returns, you'll notice an absence of dark reds. There's only a couple up here, and they were small dark reds. So that was a loss of 8.15% and a loss of 8.32% in these particular months here. But there is no major losses throughout this large monthly performance track record, and that's because this technique cuts losses short at all times. So we are never incurring these significant adverse events. This means that we are perpetually in these drawdowns, but they never get extreme. However, it's not the case with the S&P 500. We notice that some of the monthly returns are minus 12%, minus 10.65%, minus 10%. These adverse returns significantly influence compounding over the long term. They detract from the compounded wealth over the long term by virtue of the impact of what we call path-dependent return streams. In other words, we've all heard the story where if we lose 50% of our capital, we've got to then increase our capital by 100% to get back to where our beginning position before we lost that 50% of capital. That compounding effect is significant when we get these adverse returns. It dilutes the compounded wealth of our performance returns. And that's why this particular performance technique of classic trend following delivers these very strong absolute returns which are comparable to or exceed Warren Buffett's returns. That's because the signature of the equity curves produced by these programs is an optimal equity curve for compounded treatment and compounded wealth over the long term. So when we get into the nuts and bolts of what is classic trend following, now it's a trading philosophy that we apply to any liquid market. In other words, we do not say that there are any markets that offer trending opportunities greater than any other markets. We treat every single liquid market the same way, and that's because we are targeting these outliers or these anomalous directional market moves, which are not the market moves you would expect in a regular repeating pattern. These anomalous outliers occur in any liquid market, and they may occur for a variety of reasons, which we'll get into a bit later, but they are not a repeating pattern. So I know a lot of trend followers talk about a trend having to take a particular form, that these classic trend followers actually are targeting an outlier, which is a much more significant material event in the market price data than what we might be familiar with when we talk about what trends are. Now, interestingly, all of these classic trend following adopts this mantra of cutting losses short and letting profits run. So what we're doing here, by cutting losses short, we're making sure that our losses are always stunted in nature. In other words, they're like a linear sequence of wins and losses when we are not trading an outlier. So during an everyday market environment where we might be trading simply because our systems might have been triggered, we might incur some wins, but a large number of losses. But those losses and wins will be about the similar size. Now, in that environment, we're not interested in that environment, and so we regard them as almost like a random result. So we could get small wins, maybe 2 or 3 in a row. We might get 5 or 6 small losses in a row. But the nature of the magnitude of the wins and losses are very similar. So that's why we're referring to them as linear in nature. But when we say we let profits run, this is when we actually are successful and catch these outliers. And these profits are non-linear in nature. In other words, their magnitude is many times order greater than the linear wins and losses that we might achieve during the normal market regime. Now, we cut losses short and let profits run. Our key requirement is capital preservation. And so that's why we always cut losses short. We're patiently waiting in the market at all times with our systems switched on. They might not necessarily be trading, but it's a bit like a spider waiting in a web for something to be caught in the web. We are patiently waiting in the market at all times because we don't know when these outliers or these anomalies will arise. But when they do arise, they trigger our signals and we enter these anomalies with our systems. So capital preservation is essential so that we can always participate in every liquid market. So we have already said that every liquid market should be considered a possible candidate for our technique because we are ambivalent in which market, the liquid markets we do trade. But we also need to ensure that by preserving our capital at all times, that means we are present to any opportunity at all times, 24/7. And because we're systematic in nature, our systems are always available to take the trade when these opportunities arise. Now, another common feature of classic trend followers is we all use margin trades. So, for instance, we trade futures instruments or derivatives such as CFDs. These gives us the ability to achieve very wide diversification with very little capital exposure. So we need margin and margin instruments to trade. This is a bit different to, for instance, people that might want to trend follow equities. They might not want to have a leverage position in equities, so they might have, say, $100,000 of capital. They might therefore allocate $10,000 for each of the equities that they invest in, which means they're limited to only be able to invest in, say, 10 equity markets at a time. Now, we avoid this by trading these margin instruments. So that therefore means with that similar level of $100,000, we might be able to trade 40 or 50 markets or 50 systems, and we might be able to trade multiple systems for each market, which means that we might be able to trade up to 120 to 130 different individual systems, as opposed to those traders that find that their capital is limited, which restricts their ability to diversify. Diversification is such an important criteria for our method that we therefore must use these margin products that are available. But to manage the risk with this type of derivative product, we embed risk mitigation methods into our systems themselves and into our portfolios. A classic trend follower also is on these major directional price moves. They're not interested in the individual character or nature of a specific market. They're not interested in trading that feature characteristic signal that exists in a market. They're after these anomalies or outliers that might occur at any particular point in time. Also common to our process is that we use very simple price following models. If you could imagine, when we're trading these anomalous outliers, they are such highly volatile events, and they have so many different types of possible forms that we can't afford to be prescriptive with our systems in being too prescriptive in how we trade these outliers. So we attack these outliers with multiple different very simple systems to avoid the propensity to be overfit for any historical market data. So as you can imagine, because we are trading these anomalous features that they lack representation in the historical data record, we don't therefore pay much attention to the backtest or the past data. We do in relation to our risk mitigation methods as opposed to identifying what is the level of ATAA we apply for our stops and initial stops and trailing stops and for our method of position sizing. But we don't apply historical market data to prescriptively define any historical signal, as these outliers can take any number of forms, and we need, because we let profits run, we need to be very, what we call loose pants methodology. In other words, we have very simple systems, very few variables, very low chance of being overfit for any historical data, and it gives us a great degree of freedom to capture a lot of these major future directional price moves, which are anomalies. Also common, I mentioned before how we do use initial stops and trailing stops, but we use them in a different way to what you could imagine. We don't use our initial stops as a form of exiting out at all costs of our trades, because we recognize in these particular regions that we are attacking, these outliers, they're highly volatile regions, and our stops are often not recognized in these volatile moves. What does save us is our extensive diversification and our very small bet size. So if you can imagine, when I was trading back in 2014, the Swiss DPEG event that occurred with the Swiss dollar, if we can remember back to 2014, it was a flash crash for the euro and the USD trading against the Swissy. Now, I was trading that with one of these classic trend following models. I actually had 5 models. They each risked, I think, 50 basis points or 0.5% trade risk. But because of the fact that our stops weren't observed, I was hit with a 2% risk event. Now, 2% is not great in the scheme of things, and that is one of the big benefits of having very small bet sizes under very wide diversification. It gives you a degree of protection in these volatile environments. Now, the reason we do have stops and initial trailing stops is to what we call de-gas or de-risk our portfolios. In other words, because we are trading highly diversified portfolios of hundreds and maybe even thousands of systems in a diversified portfolio, we need methods in that portfolio that release risk from each of our individual systems in that portfolio to prevent us from carrying risk. In other words, when we start entering drawdowns, you'll find that our systems exit because of our stops and our trailing stops. This therefore de-risks our portfolio, allowing us to take future risk. In other words, it's always making sure that our portfolio is ready to take any future possible risk and always de-risking based on known risk that has occurred at this point in time. That is why we use initial stops and trailing stops. It's not as a measure of sort of last stop of resort measure. This is just a measure to release risk from the portfolio. Our small bet sizes are the things that actually protect us from adverse risk events. Now, because we apply extensive diversification, there's 2 broad forms of diversification we apply. One is across individual markets themselves, particularly asset classes such as commodities, forex, equities, etc. But also we apply system diversification. So we have multiple different forms of trend following system, these very simple underfit systems such as breakout methods, retracement entry into trend methods, moving average crossover methods, etc. We use a variety of different system diversification techniques, and what that does as an ensemble is when you put those systems together, it reduces the level of correlation to a particular system in that portfolio, and it increases your uncorrelated benefits in your portfolio. We'll probably see a visual example of that in a second. So the reason we use diversification is also a bit of a difference to the classic use of diversification. So you might have heard of diversification is a means to reduce the risk held by a portfolio because of the uncorrelated ensemble of return streams that are contained in the portfolio. Now, as classic trend followers, because we embed risk mitigation methods into our systems, such as our initial stops, our small bet sizes, and our trailing stops, we've got to be less concerned with correlation, because we find that there are instances in time, such as in 2008, in 2020, in 2021, in 2014, where markets under high correlation, all became correlated, became a windfall for us trend followers when we were trading the right way. So when we are obviously positioned in an incorrect way to the dominant market trend of correlated markets, we get these linear sequence of losses, and we might get a number in a row. However, we never get a linear sequence of non-linear losses. In other words, we never get these magnificent or adverse game changes that significantly lead us towards risk of ruin. What we find is that we get these linear sequence of small losses, and yes, it is a bit painful, but we take it on the chin, because when we are orientated the right way in correlated markets, we get a windfall bonanza because we let profits run across these highly correlated markets, and we find that our profits accelerate many times over. So unlike most methods that use diversification to reduce risk, our primary reason we use diversification is to hunt for outliers. So if you could imagine, because these outliers are fairly sort of seldom in nature, but we'll also discuss how wrong people are in assuming that they are very infrequent in nature. But because of their relative infrequency, and we need to be highly diversified across a vast array of different liquid asset markets, as well as across our systems, to be able to increase the frequency of these outliers in our trade distribution produced from our portfolios. So we use diversification, system and market diversification, to basically hunt for these outliers. We also use fairly long-term lookbacks, medium to long-term lookbacks with all of our systems. In other words, we're not looking at trends that are any normal, average, everyday trends. We're not interested in them. We're interested in these huge magnitude directional moves, and the lookbacks of our, for instance, our breakup models and our moving average crossovers. We're dealing in terms of between 100 to 300 days duration lookback, because we're looking for these infrequent signals that are major material events. And so when we have this extensive wide diversification, the first thing is for any particular individual instrument that we trade, which might, let's imagine that we're trading the S&P 500 as an equity index, and let's assume that we have a 40-year history of that S&P index. One of our systems might only trade around 15 to 30 times over the course of that 30-year period. So as you can imagine, the trade frequency is very low compared to how most traders like to trade. But because we've got extensive diversification of hundreds of different systems, we increase our trade frequency in our portfolio distribution trade returns. So therefore, we're very selective in the trends we trade. We're very diversified, but that allows us to increase our trade sample size. So over a 40-year period, we might have a trade sample size of 4,000 trades, and we trade each of the markets and each of our methods exactly the same way. So we're neutral in looking at the particular characteristics of each market. We trade the same model across all of our markets, and therefore that allows us to increase our trade sample size across a variety of different asset classes and market data. Importantly, this systematic approach that we apply is non-predictive in nature. We are simply following price. All of our guidance is taken by price alone, and we close our ears to any news, any of that information we're not concerned with. We're concerned with these outliers, and to catch these outliers, we need to follow price. there is no way we can predict in advance when these outliers will occur. So we need a technique, therefore, that adopts a price following process that simply it's like a surfer catching the big swells of the surf. We're simply on our surfboards waiting when that surf comes in that we know offers those big waves. So we're after the ocean swells as opposed to the beach break. When we get those ocean swells, we jump on our surfboards and ride them in. That's exactly how we should be considering our non-predictive systematic rules-based approach that we apply for classic trend following. Now, because we are trading these outliers, now most people don't really, when we can always identify an outlier in hindsight, and we say to ourselves, gosh, wouldn't it have been fantastic to trade that trend? Now, that's because all of us as traders, we adopt a predictive mindset, and we assume that when price gets to a certain level, there is inevitably this need for us to consider a retracement, or it's gone too far, it's got to retrace. However, this whole definition of these outliers being anomalies is because it defies predictive logic. It defies our mind to be able to second guess them. And therefore, this approach that we adopt is a particularly counterintuitive approach. So when we are entering our trends, most people are saying, I'm going to go counter trend. When we're long or short, we trade bidirectional, long or short, but the time we are entering trends is usually the time that a trader using a predictive mindset is saying, gosh, that price has moved too far, it's got to retrace. Now, the reason we're doing that is because we are getting into the counter-predictive or the counterintuitive way to recognize that when predictive mindsets fail or predictive models fail, that sets ourselves up for this significant windfall because a vast number of traders apply a predictive approach. So therefore, this counterintuitive approach is oppositely positioned to what they're doing. So you can imagine that during these such as the 2008 GFC, when equities were tanking, we found that we are jumping onto those short trends exactly at the time that most people with a predictive mindset are being short squeezed, and they are having to drop their predictive models because they're not working during these environments, and then fear and greed is making their decisions for them. We are sitting on the other side of that trade, taking advantage of that significant windfall that's delivered to us because it's counterintuitive. So it is a very psychologically hard process to follow. Now, I know all of us say, well, as we get into identifying some of the techniques we use, you'll say, well, that's very simple. But realize that psychologically, it's incredibly hard. And you'll find that you need to stick away from the screens. You need to rely on your systematic process. You don't want to be listening to the news. You don't want to be looking at the charts. These are things that encourage us with our predictive minds to want to interfere with our rules-based approach. Everything in our models is based on a systematic rules-based approach, and we can't afford to let our discretionary mind try and basically override that rules-based approach. Might have to move a bit faster getting through here. Now, why are we systematic? Now, over here, we'll see a table of hedge funds. We've got about 536 hedge funds, which are CTA. So as I mentioned before, with that Nielsen hedge database that we use, these are the CTAs that come out. There's about 536. You'll notice that CTA systematic trend following firms, there's 153 of them. But you'll notice that there is no CTA discretionary trend following. Up here we've got CTA discretionary fundamental, CTA discretionary market neutral. There is no CTA discretionary trend following. So it's not that people haven't tried. Many people have tried this approach using a discretionary rules-based approach. However, because we are trading such vast portfolios under such intense diversification in very volatile markets, we need, our brains simply cannot execute trades in accordance with rules if we're not systematic. So that's the reason for this absence of discretionary CTA trend following funds, is because unfortunately the machines beat us at this game when we are using this rules-based approach under extensive diversification. So the brain is not well equipped to deal with these particular trending environments or these anomalies that we'll get into in a second. They're very volatile, fast-moving environments, and they require immediate rules-based execution. And when you're trying to juggle, say, 150 active trades at a time, you don't want to be doing that in a discretionary way. You want some algorithmic process, systematic process to manage all of those rules for you. You just sit back and make sure that your execution, your rules are being executed in accordance with how you've designed them. So we employ this massive diversification. Now, also recognise that the edge we are extracting, whilst we're talking about the opportunities presented by these outliers are significant windfall events, they are few and far between. And you'll find that even though we can boast a very strong track record over 20 to 30 years, our edge actually is very weak. But as I've said before, it's because our technique provides an optimal uncompounded geometry for compounding in the long term to take hold of and lift it to the heavens. That is why our technique blossoms over the long term. Nearly all trading techniques actually have a very weak edge because there is a large amount of noise in that market data, which a lot of us don't really recognize the level of that noise in that market data. But it's omnipresent throughout all market data, even out in the medium to long-term environments that we trade this trend following technique. There is noise out there. So we have low win rates, maybe 20 to 40% win rates. So therefore 60% of the time we're losing with these small linear losses. So there is a lot of noise out there and it's a weak edge. But our technique itself allows us to, under wide diversification, extract as much of that weak edge as we can from that anomalous data in that market data to deliver compounded wealth on the long term. The brain, as we're probably aware, the neuroscience is starting to realize that the brain doesn't act like a camera. It doesn't give us a camera shot of what's actually out there. Our brain is encased in our skull and accepts all of these sensory stimulus, and then they basically, it's a predictive engine. It assigns a prediction to an outcome, and if that prediction is wrong, the brain adjusts in its memory held in that brain through a process called learning, where over the course of time, a brain is like a big optimization engine that just optimizes an experience based on the sensory data it receives. So it's very good at recognizing patterns, but it is also, it can be easily confused by outliers. So over here in this chart here, I've just done a random chart. We'll actually be constructing some of these a bit later, so you can see it. This is actually, even though it looks like normal price data, it's randomly constructed price data. It does appear to look like real data where we can place trend lines on it, even Fibonacci's, moving average, convergence, divergence indicators. They all work, but it's on randomly constructed data. So our brain tends to assign a causal reason for this data. It'll tend to try and say, well, this occurred because of this, this occurred because of this. That's this prediction engine that's taking hold. But the reality is, in this example, this is simply random market data, so it tricks our brain. So with our quantitative approach that we apply for this particular method, as I'll show you in a second, we're looking for a different reason for what causes trends. And we'll be referring to this as serial correlation of data, which we'll look at. And it's not the form, the visual form that's important. It's the bias in the market data series that is important for our models to catch. So let's move on. So here I've got an example of 16 different liquid market data. You can do this yourselves. Pick out any market data liquid market data. And the reason we trade liquid market data is that because we cut losses short at all times, we don't want to be trading illiquid market data that gives us a bigger loss than what we're prepared for with our rules-based approach. So it must be liquid market data. But as you can see here, all of these markets exhibit outliers, they exhibit trending environments. Now, you might be used to thinking in terms of trends as these prescriptive definitions of higher highs to higher highs and lower lows to higher lows, and vice versa for the short position. However, we don't think that way with this particular classic trend following approach. Not to say that those more prescriptive definitions aren't valid. Yes, for different techniques, they're valid, but not for our method where we are targeting these outliers. A trend is simply a direction, in terms of our definition, a trend is simply a directionally biased price series that can take a broad number of different forms. There is not a one-size-fits-all definition. As we're all aware, everyone interprets trends differently. All we're after here is some indication that there is some directional bias in that price data. That's all we're after. They're visually very hard to define due to the plethora of different forms they take. We can have parabolic trends, smooth linear trends, very messy trends. We can get trends with what we call volatility clusters in it. The nutshell of this is that they take a vast array of different forms. So therefore, with our particular approach, we can't be choosy. We want to be able to take any possible trend that is classed as an outlier, and it might take a number of different forms. So therefore, we need these loose pants systems to be able to address those many different forms. So being prescriptive in a trend following definition tends to reduce opportunities where we want to increase our opportunities, particularly when we are catching these outliers. And the last point is an obvious point. What is the point of defining trends anyway when hindsight doesn't really help us trade trends? We're always on that right-hand side of the chart, staring into the abyss of the uncertain future, provided we've got a directional price series behind us showing that there is some directional price that's been taken by that market data, that historical market data. We're prepared to jump on board with our surfboards and ride that unknown swell of the future. So when we are talking about trends, this example up here is a randomly constructed trend from random price data. As we look at that trend, it takes the form of what we often see in our market data are things that we might ascribe as being a trend in the market data. However, this is market data where we've got a bias imposed in the series. Now, even though that looks like a smoother linear line, when you actually bring these together and match them up, as we have done here, you'll find that visually they take a very similar form. In fact, they are identical. What differs is the bias that shifts this serially correlated series in a directional way away from the random series. So when we say we are attacking trends, we're not attacking the visual form of these trends. We are attacking the bias in the price data, and we'll be referring to this as serial correlation in this data, which I'll be showing you in an interactive demonstration what we mean there. But we are attacking the bias in the price data. We're actually not attacking the visual form. This is what is driving the trends. So when we're talking about the momentum backing behind trends, it's this serial correlation. And what we mean by serial correlation is the time dependence in the series. In other words, if I had a random price series, let's say I had 10 individual bar charts that were all independent to each other. There was no causal linkage between any of those 10 bars. That would be described as 10 random price bars. However, when we've got serial correlation, it's saying that there is some dependence at an earlier time to price at a later time. So it's saying that there is some causative relationship in that price series that is causing the bias in that price data to exert an influence on the market data. That's what we're referring to as what is causing these outliers or these anomalies. It is this, these clusters, these volatility clusters of serially correlated data that occur which amplify directional price and give it this non-linear, massive directional move. So the visual form is far less important to us than the bias in the actual series itself. And therefore we use this quantitative rules-based approach to model development that avoids visual bias. So we're not using visual methods to identify trends. We're using quantitative methods to identify whether or not there is this serial correlation in this data series that we are trading. So now we can get now to the nitty-gritty of what is an outlier. So an outlier is this non-linear directional anomaly in the market data. So here is soybeans. There are two anomalies here, and this is a soybeans 2010 up to 2021. These are two events that we would have been paying consideration to. Notice this other visual form of market data we're not interested in. The reason why we're interested in this data here is you'll see it's a very clean trend form, and there is some causative bias in that price series which is creating this clean trend form. There is limited volatility in this directional move as opposed to the volatility you see in this normal market price data here. So we're very interested in these, which we are referring to as these unidirectional price anomalies, which are much less volatile than normal market data. They are massive nonlinear magnitude events, and the causal reasons for them is attributed to what we refer to as power laws. There's some power law backing the amplitude of these directional price moves, something giving it this extra thrust, not a linear relationship. There is some amplifying quality that is creating this accelerated trend or this accelerated volatility that we're very interested in. So these things, these anomalies, when we typically talk to a lot of statisticians who are interested in looking at the individual characteristics of markets, they shake their head when they say, what do you mean you trade anomalies? We actually exclude anomalies from our data series. We believe them as unimportant. However, what we say in return is that, well, when our bread and butter is dictated by anomalies, these game-changing events, we are very focused towards what you regard as an anomaly. You might not include them, but they are essential for us. Now, when we look at what these outliers are, it's often helpful to think in terms of the standard deviation of that price move. Now, a 5 sigma event, according to a normal distribution, has a 1 in 3.5 million chance of happening, which means that once in every 3.5 million years on a day trading strategy, you might expect a 5 sigma event according to a normal distribution. And a normal distribution is how economics has typically treated market data for the last 30 to 50 years. They talk about the efficient market hypothesis. They talk that market data tends to be normally distributed or follows a Gaussian distribution. What that's saying is that they are saying that these 5 sigma events are unheard of in their lexicon. They don't recognize that these shock events like 2008 GFC, these things actually, they can't explain how they occur because they don't recognize them. They exclude them from their analysis. They are these once-off shock events. However, what we find in a 60-year historical record of the S&P 500, not a 1 in 3.5 million chance of happening, but we actually find that there were 43 events in that 60-year historical record that were greater than plus or minus 5 standard deviations in daily returns. In fact, some of them were greater than 10 standard deviations, either positive or negative. So we can see that there is something going on at these tail regions of these distributions that is significant. And if we can have these systems that target these significant opportunities in a beneficial way, you could see how these are game changers to our track record and how they deliver such stunning absolute returns. Here is another outlier in wheat. This is a recent one, as we're seeing. This is one I'm writing now. But of course, wheat has come back down. We've had a bit of a retracement since I did this glorious chart. But this is what is regarded as this directional explosion in volatility. You'll see it's significantly different to the past historic data. There is something going on here, something special that is deriving this anomalous outlier. So there's been recent research done from a large number of people. Of note is a gentleman by the name of Jean-Philippe Bouchard. He's a French physicist and he's also a quantitative trader who heads up CFM Capital. He's done extensive research recently into what is the driving factor behind these major price moves. And his conclusions are quite stunning. He's assessed 1 minute data extensively in equities and has come to the conclusion that approximately only 10% of the large directional moves can be attributed to news events, or what we call exogenous factors. So he's actually assigning 90% of those major directional price moves to internal market factors, what we call endogenous events, something caused within the market itself that is driving these explosive moves in the market data. Now, it's quite stunning research, and on Top Traders Unplugged, we've discussed this at length, where we've looked into this research, and it's really fitting well within how we define what these outliers are. We've recognised that these outliers are not generated by news events. Of course, Ukraine created the wheat move, the Ukraine war, and the crude oil spike and the Brent spike. However, that is quite infrequent when considering the vast majority of reasons that cause these massive directional price moves. So what Jean-Philippe Bouchard did was he looked at this micro data research and started looking at available research in the literature to see how we can look at his research, which was done at the microstructure level, and scale it up to these major price moves that might last 1 year, 2 years in lifespan. As I said, we are medium to long-term traders, and most of our trades we're holding for periods of between 1 and 2 years because they are such significant directional price moves. We also are not trading the minutiae of the market data, so we've got these loose pants models that hold on to these trends for very long periods of time and can create significant opportunities because we can hold on to them for so long. But anyway, the research has been scaled up where we can start answering long-held questions by, for instance, Robert Schiller, who realises that fundamentals themselves cannot account for the level of volatility in market price data, and he's suggesting that there is what he calls an excess volatility puzzle. There is some other factor or reason that is causing the dominant driver of these major price moves. And in about the 1980s to 85s, we start seeing a challenge to the efficient markets hypothesis, which is effectively stating that the reason for price moves can be assigned to fundamental reasons. Now, this is one of the big challenges that are being thrown into the mix now, suggesting that, well, actually 90% of the major price moves cannot be understood by fundamentals. There must be some other reason causing these major price moves. And this is where, since the 1980s and 85, the Santa Fe Institute in the US has had a lot of physicists enter the fray with economists to look at impacts of complex adaptive systems, where we can start looking at more realistic models to price behavior that starts looking at what are these internal effects within the market that drives these price moves. And we find that all trader behavior is basically responsible for price moves, which is reasonable when we consider that really the buy and sell signal that we all make as traders actually moves price. A lot of us don't think it moves it much, but the physicists do beg to differ. and they've done considerable research where they find that a 1% impact in the equity markets leads to a 1% increase in market capitalisation, plus or minus over the long term. And they find that the impact is even greater when a trader invests in an equity index. Let's just say that they apply 10% of capital to a trade decision in an equity index. They find that over the long term that leads to a 5 times multiplier, or a 50% increase in the overall directional price change of that index. There is this square root law which is starting to be very predominant in the literature. To give you a brief understanding of how they've identified this, is that these large investors who trade in the market data, they never basically allocate their entire trade position in one hit. They spread it out maybe over 2-3 days, where they trade in increments, equal increments over a period of time. Now, what they've found is that the impact of that breaking up into equal intervals over that period of time does not create a linear relationship between the buy or sell decision and the movement of price. We find that early on in those orders, the impact is greater than later on in those orders. There is some non-linear relationship relating to trader impact, which is moving price. And this brings us to the conclusion that there is some memory in the market. And there's been some very interesting research by Gabay and Cogen with their theory called the inelastic market hypothesis, that puts forward an idea to basically upgrade the efficient markets hypothesis to be more realistic and recognise the influence of collective trader impacts in moving price. And to understand that, what that theory basically concludes is that collective trader impacts is the most important thing for a price follower to look at, not the fundamental news events make up a small portion of price movement. So in other words, if you find a news event occurs which you view as being a positive news event, but you notice that the traders out there actually treat it as a negative news event, you best go short on that news event, even though it goes against your rational mind to try and understand whether that economic news has validity or not. Don't worry about that. Worry about what the other traders are doing, because these major price moves tend to be occurring because we get these amplification effects occurring from what we call positive feedback. In other words, what other traders are doing influence what you do as a trader, and you find that in these times of where market volatility is extreme, you find that people do tend to drop their predictive trading models, and they tend to let their behaviour take over, and that creates this positive feedback, this amplification effect that significantly extends price to get these capitulation events. So these major anomalies are game changers for our particular technique, but they're also the means of ruination for predictive traders who don't take these things seriously. Those people that discount these anomalies tend to find that they will face account blow-up, and it's a pretty sad tale, and I think we can all understand those times that that's occurred. How are we going for time? 7:46. I think I've got another 15 minutes before I'm an hour. Is that right, Darryl?
I think we've been going now for a little bit over an hour. We started at about 7:40. So
okay. Okay, so 7:40, a bit over an hour. What I'll do is I'll just quickly run through this. So what I've done here is these are daily distributions. When we get the market data of any liquid market data, we can map out in terms of a histogram plot where the daily distribution of market returns plots. We find that the vast proportion of them plot around a mean, and we find that they do tend to follow a normal distribution until you get out to these tails where you find these anomalies existing. Now, this is the zone that the classic trend follower focuses on. We are not concerned with this entire region here. This is where most predictive traders focus their efforts in extracting their edge. We're not interested in this. We're focusing on these extreme moves. And when we look at any liquid market data, we see that there is this extreme plot occurring well outside the range of the normal distribution. That's what's giving us these anomalies. Now, we can refer to the shape of these distributions actually departing from a normal distribution to approaching a leptokurtic distribution. I won't go into that detail now, but the better term is a Pareto distribution. You might have heard of that. That's the 2% rule you might have heard of, where 2% of the people get the lion's share of the profits or whatever. That is a Pareto distribution in operation there. And that's what this liquid market data tends to follow, a Pareto distribution. So we get two different phases of market behavior, that occurring in these extreme zones, which is different to that occurring in this broad zone here. 95% of traders focus their efforts on here. About 5% of traders focus their efforts on here. Now, what we call divergent traders who focus on these regions here, this is a region we refer to convergent traders focusing their efforts on. I'm going to race through this. Okay, so this is an example of these anomalies. So I've explained to you how during the, if we find that our systems are trading during normal market data, we might get a +1 event, a -1 event, a +1 event. These are linear outcomes, either favourable or unfavourable. But when we latch onto these outliers, because we've got multiple systems all catch these outliers, we don't just get one significant beneficial non-linear event, we get multiple events. So you can see how by using multiple systems, this example over here with wheat, I've got 5 different systems. You can see how they're all deployed over here. There were a few systems trading during this normal zone. This is where our systems become active during these outliers, and we benefit from these significant opportunities with multiple systems all firing. That's how we develop what we call these stepped up equity curves. So they're not smooth equity curves. Our performance profile represents these stepped up equity curves. And these step ups occur during periods of market crisis like 2008 when the S&P was tanking. There was a step up here because all of the markets were correlated and are going the same way. We were benefiting with these style of models, classic trend following models. Here's another non-linear step up. You'll notice that the size of the step ups exceed the size of the drawdowns. And what that does means that we've got these non-linear step ups which exceed these linear drawdowns, and the relationship or the ratio between the non-linear beneficial uplift in the equity curve and the linear downturn of the equity curve gives us this optimal profile for compounding over the long term. I'm not even going to go into this, but just to explain quickly, so what we do, we do not regard risk as variance around expected returns, because as you know, these outliers are unexpected events. So we've got no forecast of how we're going to go in the future. We've got no idea how we're going to go in the future. The only thing we know is that we recognize that the future is going to be different to the past. The past offers us one track record or one sequence of returns or historical returns that is going to change in the future. We're not going to get an exact repeat of that sequence of events, and that's therefore going to totally change that future. So we have no expectations of future returns. Therefore, we can't use traditional risk models such as Sharpe, such as Markowitz's efficient frontier, where they talk about standard deviation away from expected returns. That is gobbledygook for our technique. It's not gobbledygook for other techniques, but it certainly is for ours. What we view risk, we incorporate uncertainty into what we view as risk. So risk is the deviation away around any expected future return plus uncertainty of future returns added to that, because we view risk as simply the ability to lose investment capital. So our models preserve capital at all times through their risk mitigation methods that I've already explained. Now, what we do, this is an example of how some convergence systems, they hold on to risk. So they might get a nice smooth equity curve, which is deceptive. Their real risk is this green line there. This is their real equity. They're holding on to risk, and they have massive risk default at the end. That was very similar to long-term capital management story. They had this wonderful return where people thought that they had found the golden goose, but then they found that they entered this massive drawdown almost down to risk of ruin in very short shrift, and that's because they were on or warehousing their risk, because most predictive modelers do not regard uncertainty as risk. They view uncertainty as something that can't be measured, so they exclude that. We include that. You'll find in our models, this is an equity curve of a trend following model. We very rarely find that that green equity line goes below our realized balance line. This means that we never hold on to risk. We've told you how we cut losses short. This means that we never sort of get out of the trend. We always take a bit of a hit when the trend turns, but we are never sacrificing our realized balance. That is what we protect with kid gloves, because that is our trading capital. But we are prepared to take risks with that trading capital with our equity. So you'll find that our equity does float above our realized balance, but it never does this. So you'll find that we don't hold on to risk. And when we get a drawdown, because our risk is being released from the portfolio, you'll find that it doesn't extend for very long periods of time. It might last for a few months, but then all the risk gets degassed from the portfolio, and then we can take on new opportunities, and we find that we quickly come back to a new high watermark. That's different to different techniques that hold on to risk, and they find that they meet risk of ruin head on by simply holding onto that risk in their portfolio and not releasing it. So in terms of our performance track record, we measure our performance in terms of decades, not days. We had these volatile equity curves, and if you did look at our equity curves, you'd be shaking your head saying, why like this? The reason we're trading like that is we know we get this over decades with these outliers in our series. We never know when they're going to occur, but we know we're going to catch them with our models and our process. So a lot of people say, well, how does your process guarantee that you're going to capture outliers? And we say, well, most people view what we do as luck. And what does luck mean? Well, luck means that you're in the right place at the right time. So when you break luck down into that statement of being in the right place at the right time, you realize that there are three things we do that guarantee that we turn this luck statement into a process. Being in the right place means that we've always got to protect our capital. We've always got to be in a position to participate. And being in the right place also means we need to be widely diversified everywhere across these liquid market markets. And being in the right time means that we've always got to have our systems in a position to always be turned on and acting on those signals when they arrive. Just quickly, before I get onto these interactive demonstrations, this is how we view future. So if we're sitting here thinking into the future, we don't know what's going to occur. It could be any of these paths of contingent events. We don't know what path they're going to be. Now, why is it, therefore, that we can look back to the past and we see a single track record, which a lot of traders basically do all of their back testing on and assume that that back test is going to be representative of that future? Well, the reason they can see this occurring is it's hindsight bias. This track record is a track record of survivorship. That's why we've got this single track record, but a large number of these events actually occurred which resulted in risk of ruin, but you don't see that in your historical track record. Where we stand today looking into the future, we can understand that some of the future events, which we've got no way of predicting, is going to lead to risk of ruin. We just don't know what we're going to be. So we are very conservative in ensuring that we've got risk on at all times embedded within our systems, because we don't know which path we're going to end up on going into the future. So our success is over the long term. This is not a technique that generates cash flow. You can't think of it this way. So you can't measure the performance of this in terms of years or even a decade. you've got to deal with decades, 30 years, 40 years. This is something that you look at as something for your superannuation, something that is a rules-based process that occurs over a very long period of time. This is just quickly referring to levels of diversification and how what happens is if, for instance, we have a portfolio of only 4 different systems and we plot the portfolio of 4 systems, those blue dots represent the possible portfolio. So let's say we've got 500 portfolios of 4 systems. They plot the blue points. Now, as we increase the size of the diversification in our portfolio, you'll see how it starts concentrating to improve performance with lower drawdown. Now, this is because of the correlation offsets in our portfolio produced from the level of diversification that we achieve, and it reduces the level of dispersion and concentrates our performance. So it's a bit like when you go to a target range and you are a sniper and you get all the bullseyes. You'll find that diversification moves you to the bullseye with this particular approach we adopt. I'll leave this for something to look at. Now, when we develop our systems, we use an automated workflow process, and this is a fairly rigorous process which looks at a design phase where we adopt the design first logic, where we identify about 6 models, trend following models, of which some of them have to be breakout models, and of those models we then enter what we call robustness testing, where we test those models not just over a single market history. We test that in a multi-market context across our entire portfolio. So if we're trading a portfolio of 50 markets, we'll be testing those models across 50 different possible alternate histories. They have to pass all of those histories to pass our robustness phase. So you can see that there's once we know that a model has passed all of those alternate histories, we know that we've got a robust solution. Then our workflow process says, all right, this uses a very long-term data set of, say, 40 years worth of data across multi-markets of, say, 40, 50 markets or up to 100 markets. Now, what you want to do is you want to test what we call the adaptive qualities of these systems. In other words, how have they performed over the last 10 years? We not only want ones that are robust, we also want them to reflect a degree of adaptation to more recent trends, because we do recognise that with these complex adaptive markets, that trend, the nature of trends does change over the course of time, and therefore we adopt this recency test, what we refer to, into our workflow process. And at the end of this entire automated process, that's how we develop our portfolios. So here we go. I'll quickly go to a few questions before I get onto the demo. So where the 20...
Make a suggestion?
Yeah.
I'm sorry just to interrupt. I think we do need a break. We've been going for almost 90 minutes now.
No, that's great. That gives me a chance to read these questions. So when we come back, I can answer them and then get on with it.
Excellent. If that's okay with you, that'd be great. I'm just going to make myself the presenter. I just want to put up a slide and just 5 minutes, and then we'll come back to Richard and you can address some of the questions. Thank you, Richard. Richard, I'll pass the screen back to you, so I'll now make you the presenter.
Thank you, Daryl. Well, we're back. Unfortunately, time's got the better of me, but look, I think we'll get straight to these questions. So, first one from Graham. Were the 20-year historical returns listed earlier normalised average margin used? Well, the ones I showed you of the fund managers, they were the actual monthly performance returns that were put out by these fund managers. So No, they weren't normalised with respect to leverage. They were the actual raw monthly performance returns of the fund managers. Obviously, when we are undertaking our classic trend following with our portfolios, we do apply different levels of risk depending on how aggressive we want our strategies to be. I'll probably give a quick example of that a bit down the track, but no, for those particular examples I showed, they weren't normalised. From Ola, how do you adjust for different volatility of different markets? Most of the fund managers in this particular class, we do normalise volatility, and for instance, I use an ATAA based volatility normalisation method, which ensures that every single market I trade is adjusted for in terms of ATR. So my ATRs define where my initial stops go, where my trailing stops go, and my ATRs define my position sizing. So that ensures that we can trade with the same model across markets with different price characteristics. K to everyone, shifting volatility that change overnight and become normal volatility, for example. Yeah, I think that's an extension of that question on how do we adjust for volatility. I use ATR, I use a 25 period ATR for all of my models. I don't get too sciencey here at all. It's just a method that allows me to normalise my models to any liquid market. Ivor Green, you mentioned that you don't backtest to prevent curve fitting. I understand that over-optimisation can cause curve fitting, but how do you know if your systems work without backtesting? I.e., how were those systems initially set up without backtest? Well, look, what I mean is we don't pay significant attention to our backtest as far as the method to project any future returns. We do backtesting, so that is how we undertake this workflow process, which I haven't really had a chance to get into the detail of, but we do extensive testing across alternate histories. In other words, by using this multi-market approach, we're throwing our models against lots of different possible histories to see how well it's stacked up in catching those outliers. Remember, we let profits run, so we're underfit in relation to our profit expectations because we actually have no escape clause apart from a trailing exit to get out of our models. But we are optimized in relation to multi-market. So I might have a universe of, say, 50 markets I trade. They might have a history of 40 years. I make sure that my models have been applied across all of those particular alternate market histories, and that their ATR-based normalisation has been applied for the stops and trailing stops to ensure that the models all trade the same way, but we protect ourselves for any adverse risk event based on that history presented over those many different possible types of history. I hope that's explained it. Ola Hansen, how do you manage your portfolio of systems? Do you dynamically change which systems are active? Do you dynamically adjust each system's position sizing? All of our portfolios are managed systematically with algorithms. So when we get our models use simple breakout mechanisms such as a Donchian breakout method, using a Donchian channel with an initial stop, a trailing stop. We might use a moving average crossover as a supplemental trend following system. We might use a Bollinger Brand breakout method with an initial stop, trailing stop using ATR once again. We might use a box congestion trader as a breakout technique. Lots of different systems we deploy to catch various facets of these outliers, but they're all managed with algorithms and they're all automated. And as far as the position sizing goes, because we're using fixed fractional position sizing, which is assigning a percentage of risk based on our available capital to any particular trade. So, for example, I might risk 25 to 50 basis points. The lower the better, so ideally 25 basis points, but obviously the more capital you have, the lower the risk percentage you can apply. And I noticed that someone was very concerned about the use of the word bet. Now that just is a colloquial term that us trend followers use because when we say bet, it's basically saying in a very humble way, we've got no idea how this trade is going to go. It's effectively a bet to us. Every trade that we do, we don't know if it's going to be a winner or a loser. Most of the time it's a loser. However, we know that there is this universal feature present in the market called these anomalies or these outliers. When we do catch them, which we never know when, one of those bets is going to catch them. That's the only reason we're using it. We don't want it to be derogatory here. If you don't like the word bet, I'll use a different term, like a place a trade. Why are there no CAGRs above 15%? Well, that's because it was a very long track record. We're looking at a 23-year track record there, and you'll find it very hard to find a professional fund manager who's got a compound annual growth rate greater than 15%. The only ones you'll find is Jim Simons, Two Sigma, Soros, the trend followers that I've mentioned. Jerry Parker, I think, has got 26% over this course of time. That's what I mean when I say there is a weak edge in the market, and it's not a significant edge. Now, a lot of people with leverage can achieve significant results in a month, 2 months of trading, 6 months of trading, but what I'd say is that they might find that they were just lucky because random chance alone can make you a big winner. But over a very long track record, you'll find that your ability to survive demands that you have this persistent edge. You'll often find that you might be trading a model successfully for 1 or 2 years and then it doesn't work anymore. But with our trend following models, they're a bit more enduring in nature because we've tested them over such a large trade data sample. These things last 30, 50 years so far with our testing. It's different to techniques that need to change their method when they find the edge no longer exists for those particular systems. Over green, why the Marsh-Ma ratios also low? Well, that's because over the long term the Ma ratios are low. When you have a long-term track record like Warren Buffett, that's 255% plus drawdowns over his career. He's achieving a CAGR of around 15% or so, or 10%. So when you divide that CAGR by your 50% drawdown, yep, you get a low Ma ratio, and that's just the nature of the game. Why not have some shorter term systems to catch smaller trends while waiting for the big ones? Well, we do. When we get to the example, I'll give you a walkthrough. You'll see that because we're using multiple systems, they are configured differently. So some are shorter term in nature than others. So we do that. 25 period ATR would imply one would be vulnerable to major whipsaws within a 7 to 10 period. What is the likelihood that this would cause a larger consistent drawdown than expected? Well, as I said, often we do get whipsaws. We get whipsaws quite a lot, but our losses will be linear in nature. They're not going to be these adverse, non-linear, massive losses because of our risk mitigation methods that we deploy in our system. Okay, now the fun stuff. Now, the first thing I want to do is I'm just going to show you a demonstration of generating random market data and trying to discern the difference between the random market data and the real market data. So I'm just now going to go to my MetaTrader platform. So here I've got a chart of the Australian US dollar, AUD USD. This is real market data, and you'll see that let's make sure that I can sweep back. But that's the real market data. Now we've got this little script, and the way we work this script is that I'll just have a look here. Random walk. Let's make sure that's the one. Okay, so what this script does is it says, all right, let's construct using 1 minute bars random market data based on a coin flip experiment. In fact, we use a random number generator that ranges between 0 and 10. We say if on any individual minute we get a number above 5, then we go long. If we get a number below 5, we go short. So that's done on a minute basis, and then we construct the minute bars into daily bars. And I'll show you what that generates. So what I'll do is I'm just going to load okay, so I'll just go back to where we generated random data from the year 2000 up to the current day. And when you look at the form of, this is the random data, this is the real market data, you'll find that there are instances where it's very, very hard to discern the difference between the data. Of course, we're using a bar chart here and the candlesticks here, but you'll see that the nature of form of this data is very similar. Now, this is randomly generated data. So what we then say is, all right, now let's deploy what we call serial correlation in that data. So what I'll do is I'm going to generate that again, and this time I'm going to immerse some correlation in this series. And I'll show you what I mean by that. Starting from the year 2000, I insert 1, 2, 3, 4, 5 biased points or biased data series in this random data at discrete points in the time series. And what I've done here is I've just inserted this bias in the market, in the random market data at the key points where we also notice that the real market data appears to have bias. And I'll show you what it looks like. So that's now generated the random series. Now just got to go back to the beginning. So we're back at the year 2000, and this is the random series at the moment, and this is the real market data, the grey and white here, and this is still all random. Now this is where, this square here is where I've inserted the first bias in the data series. So this is the real market data where we suspect that there is some causative bias driving that price series down. This is in 2008. So I inserted that bias. No, I'll have to do this again. I'm sorry about this. Let's do it again. It runs off the screen, unfortunately. I need something that's... there we go. Let's see if that looks better. Yeah, that's a bit closer. Right. So here is this downturn in the market that we suspect is being caused by correlation in this data series. So we've inserted correlation over this window here, and you can see its effect on the random data. So at this point here, we get a separation of the correlation in the series now diverges this from the random market data to this point here. And then you find that the random market data series and this series obey the same trajectories until they get to another correlated patch. Here is another correlated patch where we've inserted bias in the series, and you can see that this bias was inserted over a longer period of time, but there is a difference in the variation between the biased market data and the random data, but visually you won't see the difference. Here is another series of serially correlated data, which visually it's very hard to tell that there's a difference. Now, what it does is this is all the difference you need to creating this necessary edge in our models. Now, this quick example just illustrates random market data versus real market data, and where we can insert in the random data some bias in the series at discrete points. But even better now, what we do is we use this randomizer here. So what I'll do is, so what this particular randomizer that I'll be showing you does is it says, here is the Euro USD market data, real market data. It says, let's look at the nature of that real market data, and I'll just go back to my presentation. Plot something here. So it says, in that real market data, there is information regarding the high, the open, the low, and the close of each of these bars, And it says what it wants to do is it collects all of the information of the distance between the high and the open, the high and the close, the high and the low, and it collects all of this information, and then it randomly reshuffles that information to break any serial correlation that might exist in that real market data. So in that real market data, there will be clusters of volatility in that real market data, as I've shown before, where there was some serial bias actually altering the trajectory of that price series. But there'll be other periods of time where it's random. So by using this technique of using this script to break the correlation in the data, we're reshuffling all this data to break any causal links that exist in those correlated regions. Now, once we do that, when we trade our trend following models on any of those random market series, they all deteriorate. But this is the visual form randomly shuffled market data looks like. It almost appears identical to the real market data. You can't tell a difference. But when we apply our trading models to that data, they all deteriorate. However, when we apply those same trade models to real market data, they all achieve the significant positively sloping equity curves. So there is, this is just demonstrating where there is this bias in the data series which is generating all of the edge in our particular models. It's not the visual form that's important, it's that bias in the data. This is another interesting interactive demo. So just to explain, this is 500, sorry, this is, I think it's 30 different equity curves produced on a trade sample of 500 of randomly generated equity curves from a trend following model. As you can see, over the first 240 trades, some of the models have been incredibly successful. This one started with $1,000, has now gone up 2.5 times to $2,500 by 230 trades. 230 trades is quite a large number of trades. However, you'll see that over the course of time it slowly deteriorates. But you'll see that just using random luck alone, you can get an array of positive results or negative results. So in this in this zero-sum game of trading, there is no, you might be lucky. You might be lucky over the short term, but you certainly won't be lucky over the long term. And I'll show you what I mean. So this is over 500 trades where some of them were lucky. This one achieved a return of $2,000 from an initial start of $1,000. Quite a large number of them are positive, quite a few are negative. However, now we go to a trade sample that is increased. So what we've plotted here is a trend following system using real market data with an edge. Now, in a trade sample of 500 trades, you won't be able to discriminate between random luck and your edge. That's just the nature of this game. You'll find here that if, for instance, you selected the system that produced this equity curve, that was a randomly generated equity curve. This therefore was curve fit to the historical data, and that's why it performed well. However, the one that actually has the edge, which we'll see later, actually didn't perform very well at all. It still sort of underperforms over 500 trades. So let's now go to 2,000 trades. You can start seeing that the system with the edge starts lifting and basically exceeding the random equity curves. It's starting to get better, but this is after 2,000 trades. So you can only assess your performance over a very large sample size, but this is how this edge under compounding starts playing out with a greater number of trades. This is now 5,000 trades. All of these random generated series slowly, with frictional drag of the costs of trading, slippage, brokerage, etc., are slowly declining down to zero almost. But the one with the edge, even though it had pretty subdued performance in the early days, now clearly shines as the dominant system with the edge. This is how our models work over the long term, and now this is going to a trade sample size of 10,000 trades. you'll see that the random results are now gone to zero effectively, have almost disappeared. But this is how our systems with an edge over a very long trade data sample, many different regimes, plays out over the long term. So now what I'll do now is we can go quickly to an example of a live workflow for a single market. Just to explain, in this workflow that we use to generate our portfolios, the first stage is this design-led approach where we develop our simple trend following models. In this particular example I'm going to be showing you now, we're using 6 simple trend following models: a Donchian breakup model, a Bollinger Band retracement model, a moving average crossover model, a congestion breakout trader model, a Bollinger Band breakup model, and what we call a standard deviation channel breakout model. There are these 6 different simple trend following models. When I say simple, these are the variables that have these are the parameters and the very few number of variables used for our models. You'll see that there is a single entry, there is a single exit through a trailing stop, there is a single initial stop. We use very simple but robust systems. So now I'll give you an example of a walkthrough, and we can see how it performs with these multiple models on the Euro USD, and we'll use a back to 1980, and we'll do a walkthrough right up to the current day, and I'll just get this running. So just to explain this model, just show you the settings we're using for this model. This is just an example I've used for this demonstration. So a sec. So in this portfolio, you can see we're trading lots of markets here. Now we're going to be trading Euro USD for this particular model, and you can see that in this model we're using 6 different systems. The BBB is a Bollinger Band breakout model, BBR is a Bollinger Band retracement entry into trend model, the box is this congestion trader model, the Donchian breakout model, the moving average crossover model, and the standard deviation channel model. We're using just 6 systems here. And I'll show you how these 6 systems work over a very long-term sample set. Now remember, this is being tested across 40 different markets or 50 different markets, and it's robust. So I'll just turn on visual now. Okay, what's it doing? I know what it's doing. There we go. Now hopefully I'll get this going a bit. I'll move it on about 10 years. Let's see. Hopefully everyone can see this. So we have our market data and we have our models working. Now, in this particular instance, you'll see that we've got 1 trade working. There's an initial stop. There's 2 trades working here. There's multiple models working as the trends become more material in nature. But every single system that's deployed here has got an initial stop and a trailing stop. You can see how these trailing stops move up behind price. So we're basically catching this large material trend here with these very simple models, multiple models as I've explained. In this case you can see how we've had many different attacks at the cherry. There is no specific trend definition we're looking at here. What we're doing is we're hitting these outliers with lots of different models that can target different trajectories that these outliers take. So as we're rolling through, we'll just keep our equity curve. You can see that our equity curve is generously rising over time, but our sample size is fairly low. At the end, we'll see the total sample size. Now we're entering shorts. So we're using simple models that are assessing the direction of the trend, and we get lots of models active when we get outliers, but very few models active when we get normal market regimes. So you can see that we are targeting these material trends when they emerge. We're not really interested in taking all the signals. We're just interested in taking the signals when we get these outliers occurring. I'll speed things up a bit here, but hopefully it gives you an idea of how our automated systems work and how we often get multiple models working. We're at 1990 now. Things are going quite well. So the decade from 1980 to 1990 has been a pretty good one. You can see these simple models working. Move it forward a bit faster. Let's get up to something a bit more recent. See, here's a good example of an outlier. So you can see how we've got 4 different systems here deployed. 1, 2, 3, 4. They have different entry points, so that gives us entry diversification. The stops and the trailing stops have different configurations, so we're getting lots of different diversification in our systems that we're deploying to catch these outliers, but this is applied to a single market. But hopefully it gives you an idea of how, and some of them last a long period of time. This is trading from 2006 up to 2008 in a long trend here. You'll see that lots of them hold for many years. Some of them are shorter term in nature, capturing shorter term trend segments. So here we get a big, this is a big short trade opportunity with multiple systems firing at the moment. Let's try and load that up. So this is a big outlier in 2014 on Euro USD. We've had multiple attacks at this outlier with our many systems. Now you can see how it's gone quiet. It's not in an outlier zone. But when it does get these outliers, we start getting very active. And let's bring it to the end. Okay, so we're now to current day, and we'll have a quick look. So that's the equity curve produced from Euro USD. You know, it's a fairly volatile equity curve. It's certainly not a stunning equity curve, but it's a robust equity curve. And it also shows us how we've been playing with our open profits here to try and generate some more realised balance. We find that we don't have these situations of risk weakness where we are warehousing risk or carrying risk in our portfolios. This is just one market of a potential 50 market portfolio, but it gives you an idea. And when I look at the report, so in this case for Euro USD, we only had 197 trades over this 40-year period. But if we've got a portfolio, say 50 markets or 100 markets, I think Jerry Parker's trading 170 markets currently. If you had 170 markets and you had 200 trades per market, you can see how your sample size does increase significantly in number. Our profit factor is pretty ordinary, 1.68. You can see short positions 152%, long positions 152%. So this has been a pretty good result. Usually it ranges between 30 to 40%, maybe sometimes even 20% sometimes with some of the markets. But you can see that the largest profit trade was $4,000, which was our largest loss trade was $500. So you can see that we've got about an 8 times R value there for that result, which is those trades have caught what I regard as outliers. Now, our trade distribution of returns has this aspect called positive skew, which means that only 5 to 10% of our trades actually account for all of our profit. 90% is basically just keeping our head above water. So that's an example of Euro USD, an example of a single market with our algorithms working. And so when we get to putting the entire portfolio together, you could imagine that we have multiple markets here. In this case, there's a few markets in here, maybe 20 markets. When we compile these sub-portfolios together, because we've got extensive system diversification in there, as well as a degree of market diversification, you'll see that there are periods of time where many of the same or different same thing. This is because they become positively correlated at times, but we can be the beneficiaries of that positive correlation. But you'll see that when we compile these together, we generate a very good result. So I'll just run to an example now of This is an example of a model of there's about 20 odd portfolios here. When I look at the equity charts on this portfolio, wait a sec. So you can see it looks like spaghetti here. We've got around 20 or so markets, cocoa, coffee, cotton, Euro JPY, the DAX, the NASDAQ, etc., silver. But, you know, none of them are to crow about. None of these individual equity curves are to crow about. But where the secret sauce comes in is how we compile them together into our consolidated portfolio. And when we do that, we get something from this result. We get something like this, which I'll just show you. So here is the global portfolio result, those 20 markets all being put together. You can see that we've had a pretty good result. It sort of puts us in the ballpark range of some of those fund managers you were looking at before, about an 8% CAGR, a 39% drawdown over, in this case, we've got since 1990, we've got this portfolio running. You can see that the winning percentage for the portfolio is 38%. You can see that the largest win, because this is a compounded portfolio now, so when we get to this level of the portfolio compilation, we can start weekly compounding the portfolio, and you can see that this is what actually delivers this good equity curve over the long term. But it turns this point at $0 here up to a good result at the end of 22 years or so, from 1991 up to currently 30 odd years. So that's sort of the end stage result. And I hope I haven't bored you to death too much, but thanks very much for listening, and we'll go to questions and see if anyone wants to bring up any points. I'll just have a look here at some of these things. So I think I responded to this. We use shorter term systems to catch smaller trends. We do use shorter term systems, but mind you, we don't get down to the intraday. We never get down to the intraday. So probably our shortest term trends are with lookbacks of around 50 or so lookback days. So in the scheme of what you're probably considering, no, we're not short term, but we do have lookback periods of between 50 to 100 days, lookback periods from about 100 to 300 days. Some lookback periods even go up to 500 days for the very long-term ones that we're writing for many, many years. But that's just the way we keep away from the noise and the mean reversion. You know how I mentioned that the market exhibits two broad forms of character. That character exhibited in the tail regions, the distribution of market returns, and that behaviour that's exhibited in the bulk of the distribution of returns. We avoid that bulk, and we're only trading those tail regions, so therefore we're using very long-term lookbacks to capture those tail regions. 25 period ATR, I think I've already talked about that. Got it, linear losses, thank you, there you go. Can you please repeat the test after by setting the spread to 40 instead? Yeah, sure, okay. Just to show you, so let's go to 40. You can see with our particular models, they when we do small things like change things like this, they have no material impact because we're trading such medium-term to long-term results. So just running the test now. So I've just changed it to 40. It doesn't materially affect our equity curves at all. So that's because, yes, when you're trading curve fit result solutions, yes, and you're trading intraday, yes, slippage and all of these things becomes a big deal. But when you're trading things that hold for 2 to 3 years, seriously, slippage is the least of your worries, and the spread, the swap, they're the least of your worries. These magnitude events which create these outliers, if you look at this equity curve, you'll see that there's a few outliers in this region up here, big outlier here, big outlier here. The rest is just random results, you know, losses, wins, losses, wins. These step-ups are responding to these outliers in the market data. There's only a few of them in any individual market, but things such as slippage, spread, all of these things, doesn't materially affect our results. So when we go to the results here using 40 basis point spread, 200 trades, bit different, 1.64, I think it was 1.68 before, very little difference, no material change. Hope that makes sense to you. Does each strategy have multiple open positions simultaneously? So each strategy only ever has one trade open at a time, but because we use, in this case, 6 different systems, there can be times where all of those 6 systems are active. So at any point in time for one market, we might have 6 systems, and therefore for a portfolio of say 100 markets, we might have 100 times 6 systems or 600 active trades. That's possible. We're trading on margin, remember, as opposed to an equity trader who allocates all of their capital, all of their available capital to equities. Thank you very much for your comment, David. Do you look at ADX? Yes, look, those simple models, ADX is a good model to use. We could incorporate a bit of ADX into those models to give us a bit of an extra confirmatory signal with a momentum burst. We do keep our models really simple because we don't want to find they are curve fit. If you can imagine, if for instance, if there's any sniff of a curve fit model here, we'll find that the future we're going to find these awful deteriorating returns. So we keep our variables low, but ADX is a good one to supplement, to ensure that you've got this volatility expansion into those outliers. Why is there such a difference in drawdowns? 40% and now in past 10 years or so years, not even 10%. Well, it's, you know, post the trend followers had a bit of a hard time post GFC when QFC, the QE, quantitative easing, occurred, regulatory intervention between around about 2010 up to 2019. What that did, that suppressed volatility in the market, it suppressed trending conditions in the market. Trend followers still did blossom at certain times, but not throughout that period. 2014 was a good time they did well. I think you know, there were sporadic periods where trend followers did well. But now, since 2019, we think central banks are probably losing their firepower a bit, but certainly markets have now turned into solid trending markets. We've had some magnificent trends in wheat, spot crude, Brent. Our performance in the last 3 years has never been higher. In fact, over the last 3 years, historically, the classic trend followers have had their strongest performance ever. So yeah. Thank you very much, Romy. Use any other methods of trendiness? Well, look, Hurst is... These are methods that we could use in hindsight to detect that there is serial correlation in the market. We could use Webb's tests in the data to actually confirm that there was serial correlation. But I know when I look at those market distributions of returns and I see that, that tail nature in the distribution of returns, or that general Pareto distribution, I know that there's serial correlation in there. That's something that just experience brings, but you'll find that the vast proportion of the market data is random in nature, but there will be these clustered serial correlation points, and Hurst does pick that up, but that is a hindsight measure, something to validate that there is these correlated clusters in there, but it's not helpful for trading, but very good as a research project. Thank you. That's also the ways. Thanks, Kay. What platforms are you using to run the system? Well, for me, because I'm a humble retail trader, I don't have the capital that a lot of these fund managers have, so I use CFDs to give me my leverage. So I'm using MetaTrader as my preferred platform. So I work closely with a programmer who does all of the heavy lifting of all of the algorithmic work behind our systems. I'm just the front-end face, that's what we're speaking of things, but he's a real heavy lifter. But so we're using MetaTrader 4 and we have our in-house program. So if you could imagine, I told you that we use an automated process, so I'll just show you. So if you can imagine, these are algorithms. This is a sequential workflow process of around about 15 algorithms that are all automated. So we have to configure each of the settings for our different systems, or the data mining variations that it can undertake. And then we click on this, run it, and it runs through this entire sequence. And it might take 5 days to generate a robust enough portfolio for us to be happy with. We do this process yearly, so we're only changing our portfolios with a complete refresh yearly. And the reason we do that is each year that we do it, we get an extra year of data, and we use a 10-year window, this adaptive window recency test, which moves in 10-year intervals to ensure that trend following systems are always what we refer to as a razor-sharp portfolio. We keep our portfolio razor-sharp with our models, that they are still responding to more recent trending conditions as opposed to trending conditions in the past. Thanks, Richard. Thanks very much, guys. Thanks, Jason, and thanks, Claude. And Ole, thanks, Ole. So I think that's it for questions.
Well, thank you so very much, Richard, for a very thought-provoking, a very unique presentation. There's so much work that you've put into this presentation, and we thank you so very, very much. I know that I'm imagining everyone on this call will be looking at the recording, because there's so many pearls of wisdom that you've got in there. It's really, really excellent. So, Richard, if people wanted to ask you any questions, is there an email address that they can send to you, or
Yeah.
is that okay?
Yeah, that's fine, Daryl. So my email address is ats118765@gmail.com. That gets me. Or you can go to our website, which is the Traders Outpost website. That'll be in the hopefully recording session, or Daryl, maybe I'll give that to you, the web address. It's that's atstrading-solutions.com. That's the website address. And if you put comments on that website, that should be able to get through to me. So atstrading-solutions, all one word, .com. Or yep, you can catch me on Twitter as well. RichB118 is my Twitter handle, or on LinkedIn. So there's all those ways you can get hold of me.
Well, you've been very generous with your time. I know people who are systematic traders have gained so much from this. So on their behalf, I just want to say a very special thank you, Richard. We will post this recording just as soon as we can. And just finally, just to remind people about our catch-up on the Monday the 2nd of May. Put that in your diary, and look forward to seeing you. So with that, I'll end the meeting for tonight and say thank you once again, and thank you everyone for attending this meeting. It's much appreciated.